In 1970, there were 400,000 textile workers in the United States. They lived in a small town in New England. Walking into the factory with white smoke every day, they weave the sheets and shirts of American families with their own hands. Their children grew up to the sound of factory bells. Their communities thrived because of the factory. By 2025, most of these factories have become ruins. One of the largest employers in the United States is Blackstone Group. This is a private equity firm with over $1.1 trillion in assets under management. This is not an accident of fate. This is a civilization transformation that has lasted half a century. From creating value to operating capital, from human collaboration to the rule of algorithms and leverage. We often think of economics as the science of growth, employment, and wealth. But today, the American economy has long become a philosophical practice. It constantly answers a question: what is the good life worth pursuing? And Wall Street is using capital as a pen to rewrite this answer. In 1950, manufacturing accounted for 27% of U.S. GDP. By 2025, the proportion of manufacturing will fall to 10.1%. This means that the United States is no longer a country that builds things. It is a country that plays with money. In 1980, Wall Street accounted for only 8% of all U.S. corporate profits. By 2006, this proportion had soared to 40%. In 2025, despite the rise of technology companies, the financial sector still accounts for 26% of total corporate profits, second only to the technology industry. The average annual salary for New York Stock Exchange traders will be $136,000 in 2025. The median annual salary for U.S. manufacturing workers is $55,000. The gap is more than 2.47 times. Capital is making more money than labor. But there is a profound philosophical question hidden here. When making money becomes an end in itself, not a means, have we confused wealth with worth? In Nicomachean Ethics, the ancient Greek philosopher Aristotle distinguished between two: economic housekeeping, managing resources for a better life; the acquisition economy, the art of unlimited wealth accumulation. Today's Wall Street is no longer a housekeeping. It's pure acquisition. It doesn't care what is produced, only the rate of return. We are using the scale of capital to measure everything, including human dignity. In 1973, the oil crisis broke out. Oil prices soared from $3 to $14 per barrel. The share of household spending on gasoline rose from 3.5% in 1970 to 9.2% in 1981, equivalent to an extra $150 per month, based on 2025 purchasing power. The steel, textile, shipbuilding, and other industries have also been defeated in the global competition. Between 1980 and 1990, the U.S. manufacturing industry lost nearly 3 million jobs. The manufacturing crescent around the Great Lakes, Buffalo, Pittsburgh, and Cleveland became the Rust Belt. The unemployment rate once exceeded 18%. In 2025, recovery in these regions will remain slow. The average unemployment rate in the 12 major cities of the Rust Belt remains at 6.1%, higher than the national average of 4.3%. Youngstown, Pennsylvania, Akron, Ohio, etc. The city's population has decreased by more than 30% since 1980. Manufacturing jobs are down nearly 70% from their 1979 peak. These workers are not lazy or out of skill. They are the reasonable victims of the logic of financial capital. As Warren Buffett admitted in 1986, "I should have closed Berkshire's textile mills sooner. Adam Smith would not approve of my delay. But Karl Marx wouldn't have approved of me finally shutting it down." The cold logic of capitalism is, if a company cannot create the greatest return for shareholders, it doesn't need to exist. But there lies a profound ethical dilemma. When efficiency becomes the only criterion, community, loyalty, stability, these emotional values that humans rely on for survival, should it be abandoned? German philosopher Jürgen Habermas once warned, when the system, economy, bureaucracy, invades the life world, family, community, culture, society will lose its cohesion. Today's Rust Belt is a living example of this systematic colonization. Factories are closing, churches are vacant, marriage rates are declining, and the opioid crisis is spreading. It's not that people are lazy, but that the meaning has collapsed. 1980s. Michael Milken revolutionized the fate of American businesses with junk bonds. By 1987, the U.S. high-yield bond market has grown from $10 billion in 1979 to soared to $190 billion. By 2025, This market has evolved into a more complex financial ecosystem. U.S. high-yield bond market reaches $2.1 trillion. Private equity. Assets under management reached $6.8 trillion US dollars, more than 10 times that of 2000. Of the top 10 private equity firms globally, 7 are American. Blackstone, KKR, Carlyle, and others control hundreds of billions of dollars in capital. They are no longer junk bond dealers, but the arbiter of the company's fate. But here is a philosophical question. When capital can reorganize, dismantle, and restructure human organizations, enterprises, at will, has it acquired some kind of creator power? French philosopher Jean Baudrillard once said, "Capital is no longer a tool of production but a system of symbols that simulates reality." Today's mergers and acquisitions are no longer based on "we need this factory," but this asset portfolio can improve valuation. Enterprises are no longer collaborations between people, but an optimizable balance sheet. We are using algorithms and Excel to redefine the value of people. In 2025, among the top 100 listed companies in the United States, 73% have been publicly challenged by activist investors in the past 5 years. These investors require layoffs, stock buybacks, selling non-core assets. Result? S&P 500 companies cut an average of about 120,000 jobs annually to boost efficiency. In 2024, the total amount of stock repurchases by listed companies reached $1.2 trillion, a record high. The proportion of employee wages in corporate expenditure, from 62% in 1980 to 48% in 2025. Return on capital employed, ROIC, becomes a CEO's key performance indicator, rather than job stability or community contribution. Behind this is a victory of utilitarianism. The greatest happiness for the greatest number of people is reduced to the greatest return for shareholders. But John Rawls reminds us in A Theory of Justice, a just society, we should not only pursue efficiency, but also protect the bottom line of the most vulnerable. But today's financial system is systematically weakening this bottom line. It rewards mobility and penalizes loyalty, rewards short-term returns and penalize long-term investment, rewarding capital and punishing labor. We are building a world of extreme efficiency but extreme indifference. In 1980, the richest 1% of American households owned 22% of the nation's wealth. By 2025, this proportion will soar to 33.1%, equivalent to $58 trillion. In 1971, middle-class families accounted for 61% of the U.S. population. By 2025, this proportion will drop to 48.7%, the lowest since 1970. Average annual salary of S&P 500 CEOs. In 1980, it was 42 times that of the average worker. By 2025, this multiple will reach 342 times. Average CEO salary, $21.3 million. The financial industry has become a wealth accelerator. But for ordinary people, life is getting harder and harder. In 1980, the average American household's debt-to-income ratio was 60%. By 2025, this proportion will reach 108%. Most families cannot make ends meet. 45% of Americans say they couldn't handle a $400 emergency expense. We are experiencing an epidemic of existential anxiety. It's not because of material scarcity. It's because of the loss of meaning. When a person's work can be optimized, when a community can be reorganized to disappear, when a person's worth is defined by their net worth, do we still believe that people themselves are the end, not the means? In the 1980s, in the TV series Family Ties, the protagonist's dream was to become a millionaire. In the 1987 film Wall Street, Michael Douglas said, "Greed is good." In 2025, this mentality has become ingrained. 63 million Americans own stocks, representing 59% of the adult population. But 82% of stock wealth is held by the richest 10% of households. Robinhood and other zero-commission platforms have over 25 million users. Average daily transaction volume reaches 3 million. Ordinary people are encouraged to invest in themselves, buy ETFs, and become shareholders. But the reality is, most people are just spectators of the capital game. A minority of people are players. Behind this lies a neoliberal metaphysics. You are not determined by birth, but by choices. If you're poor, it's not because of the system, it's because you're not smart enough. But is this true? A descendant of textile workers from the Rust Belt. Are you really starting from the same starting line as the child of a Manhattan hedge fund manager? We are using the language of freedom to cover up the reality of inequality. In 2025, the largest financial institutions in the United States will control staggering resources. BlackRock manages $10.9 trillion in assets, more than one-third of the U.S. GDP. Vanguard Group manages $9.1 trillion. It is one of the top 10 shareholders of more than 4,200 listed companies worldwide. Goldman Sachs and J.P. Morgan Chase are not only banks. It is also the shadow board of corporate governance. They can decide who will be the CEO, who was laid off, which factory should be closed. Finance is no longer the service sector of the economy, but the dominant force. 50 years ago, an American, they talk about factory output, union negotiations, and their children's college tuition. In 2025, he's more likely to be checking Tesla's stock price on Robinhood or discuss Bitcoin on Reddit. This is not progress or regression, but reality. Wall Street didn't invent the steam engine, but it uses the logic of capital to determine who owns the factory, who lost their job, who becomes rich, who becomes rust. It makes America more efficient, also more unequal, richer, also more anxious. But the deepest price may not be money. It's our imagination of good life. It has been completely reshaped by capital. We began to believe that growth is good, efficiency is good, the return is good, but we rarely ask, what is worth growing? Efficiency for whom? Whose reward is fair? Maybe. True freedom does not mean becoming the master of capital. It is the ability to refuse to let capital become the master of our lives.